Hello, welcome back to this week's market update. Today is Monday, January 27th, 2025, and with that, we will jump right in. Last week, economic data was relatively quiet with attention focused on President Trump's inauguration, as well as his series of executive orders on top of the continuation of Q4 earnings season. The S&P 500 reached new all-time highs and major indices posted gains. You can see here as of Friday, January 24th, the Dow Jones Industrial Average was up 2.15%, the S&P 500 up about 1.7, Nasdaq following at 1.6% gain for the week, and then the Barclays Aggregate Bond Index just about flat, up almost 0.1% last week. So as we look at the markets on Monday morning here, we have some AI concerns in the market. Now, this is not technically last week's market news. It's more so the opening as well as over the weekend. So looking at the markets right now, about 10:30 a.m. Eastern time, you can see the Dow is about flat. The S&P is down almost 1.5%. The Nasdaq down 2.3%. And it was worse at the start of the market open. So it seems like the market may be calming down from the concerns this morning, but essentially what the concern was the weekend rollout of China's DeepSeek AI platform, similar to ChatGPT. It is a free open source large language model that was first launched in late December, but rolled out more so over the weekend. They claim that the model was developed in just 2 months at a cost of under 6 million, so a huge contrast to all the amount of capex that we've seen US tech companies investing in AI, as well as the amount of time it's taken several years, especially since you look at just the launch of ChatGPT a few years ago, and it has been improving significantly. But if this is the case, if China's AI model called DeepSeek was actually launched with just a few $1 million and within a few months, this is a real concern for the competitiveness of US companies in AI and technology. So earnings season will be super important to seeing how AI companies, how technology related companies in the US are actually performing. Are they getting that bottom line growth from AI adoption? That'll be really important as we look at the market in the coming weeks. With nearly 20% of the S&P 500 having reported earnings, we can take a look at where they are right here. Now, this is just a minority of the companies reported, but so far we're seeing almost 50% year-over-year earnings growth across the index that has reported, and that is really led by financials, which a lot of financial companies, about just over a third, have reported so far, and the results look very good. So a lot of deal-making revenue as well as tailwinds from higher interest rates. Overall, we expect the rest of the S&P 500 to have a little bit more moderate earnings growth. Analysts currently have that at around 6.4% here, which would lead to about a 13% year-over-year earnings growth across the S&P 500. So we'll have to wait and see. Several sectors are expected to have weaker earnings growth. You could see materials, discretionary, energy, consumer staples, but we'll have to see how earnings season actually plays out, if these expectedly weaker sectors are weaker, and if companies like technology, near cyclicals, real estate, if those can really impress and post the earnings growth that analysts are looking for. Last week, we also got the leading economic index from the Conference Board falling slightly in the month of December, about 0.1% lower than November. In the second half of 2024, we also saw the LEI, the leading economic index, that fell by 1.3% over the last 6 months, compared to a steeper 1.7% decline in the first half of 2024. Within the LEI here, we can look and see things like leading credit, the S&P 500, as well as average weekly hours in manufacturing. Those were all positive contributors, while things like average consumer expectations for business conditions declined in December, new orders, and weekly initial claims here. And then we had several sectors flat, so things like manufacturers, new orders in non-defense capital goods, as well as consumer goods. Those were pretty flat, as well as interest rate spreads. This is something that was a negative indicator, the inverted yield curve, but has now turned into a more neutral indicator. So the LEI overall, it was signaling a recession for quite some while. Now it is pointing to just a slowdown in the economy, not necessarily a recession. So we'll continue to watch and see what it signals. Panning back at our other recession indicators here, you can see we have 5 bullish. So we have the ADS that recently turned bullish, the services index, which has been bullish for quite some while, the business outlook survey that's been bullish, the employment trends index that's been bullish, and then the anxious index, which we'll get an update in February too here shortly. And then we have 3 bearish indicators here, the manufacturing index, ISM manufacturing, the LEI that we just took a look at. Now that has improved in recent months, so it is still bearish, but it has gotten better recently. And then the Chicago Fed's National Activity Index. So overall, a bit more bullish than we were a month ago, but still kind of in that cautious optimism. Lastly, we also got some data in the residential real estate sector in existing home sales for the month of December. They came to a seasonally adjusted annual rate of 4.24 million. This was up 2.2% from November and 9.3% from December of 2023. We did also see inventory creep up slightly from 3.1 to 3.3 months worth, and the median sales price rose about 6% to 404,400 in December. For 2024 as a whole, total existing home sales reached 4.06 million, reflecting the lowest sales volume since 1995, also highlighting the pressure of high rates and high prices and how they've really had an impact on the market in recent years. Thank you so much for tuning in to this week's market update, and we look forward to providing another update to you very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.